In a significant move that reflects the evolving landscape of cryptocurrency regulations, the U.S. Securities and Exchange Commission (SEC) has issued new guidance aimed at crypto asset offerings and registrations. The announcement made on April 10, 2025 by the SEC's Division of Corporation Finance is intended to clarify disclosure obligations under federal securities laws for entities operating within the cryptocurrency space. This guidance comes at a time when the SEC appears to be shifting its approach, seeking to engage more cooperatively with market participants rather than strictly enforcing regulations. The SEC's statement marks a notable pivot, especially following recent developments where the agency has backed away from several enforcement actions against crypto firms. For instance, it recently dismissed a civil enforcement action against Coinbase and clarified that many meme coins do not fall under the category of securities. This trend suggests a more accommodating regulatory environment. As highlighted by SEC Commissioner Hester Peirce, who emphasized the importance of collaboration with the crypto community. We invite builders, enthusiasts, and skeptics to engage with us to figure out what the final rules should be, she stated, underscoring the SEC's commitment to fostering innovation within the sector. The guidance published by the SEC identifies common issues encountered in the disclosures made by crypto asset issuers, particularly in relation to offerings under the Securities Act of 1933 and registrations under the Securities Exchange Act of 1934. The SEC's staff organized its recommendations into 6 key areas that issuers should focus on to ensure compliance with disclosure requirements. These areas include a clear description of the business, comprehensive risk factors, a detailed description of the securities being offered, and transparency regarding key personnel involved in the issuer's operations. In particular, the SEC advises that descriptions of the business should be tailored to the issuer's specific operations rather than relying on generic language pertaining to crypto networks or assets. They further recommend that issuers disclose how they plan to generate revenue and the role of any crypto assets in their business models. The emphasis on clear and concise language aims to enhance investor understanding and protect consumers in an industry often criticized for its complexity and lack of transparency. Meanwhile, in parallel developments, the global crypto exchange OKX has made headlines with its expansion into the U.S. market. As of April 16, 2025, the exchange has launched its trading platform in 46 states and Washington, D.C., and appointed Roshan Robert, a financial services veteran, as its new U.S. CEO. OKX's move is particularly strategic, coinciding with a more favorable regulatory outlook in the U.S. as the government under President Trump has taken steps to encourage cryptocurrency innovation. Robert expressed optimism about the company's potential impact in the U.S. market, stating, "What we are bringing to the U.S. is a new alternative where we give users more freedom to choose." This sentiment resonates with the SEC's recent guidance, which aims to create a more supportive environment for crypto businesses. OKX's new self-custody wallet, which supports over 130 blockchains, further positions the exchange as a competitive player in the rapidly evolving U.S. crypto landscape. As these developments unfold, the broader implications for the cryptocurrency market are significant. While the SEC's guidance may provide a clearer framework for compliance, the crypto community remains vigilant, aware that the regulatory landscape is still in flux. Investors and issuers alike are encouraged to adapt to these changes as the SEC continues to refine its approach to this burgeoning sector. Looking ahead, the ongoing dialogue between regulators and the cryptocurrency industry will likely shape the future of digital assets in the U.S. As the SEC works to establish a comprehensive regulatory framework, the actions taken by exchanges like OKX and the responses from crypto issuers will play a crucial role in determining how this dynamic market evolves in the months and years to come. As the world of finance becomes increasingly complex, the dynamics of cryptocurrency markets are evolving, prompting analysts and investors to draw parallels between Bitcoin and traditional tech stocks. Recent developments indicate that Bitcoin's price is not only influenced by its unique market factors but also by broader economic trends, particularly in liquidity and regulatory frameworks. On April 16, 2025, Bitcoin experienced a notable price drop coinciding with a speech by Federal Reserve Chairman Jerome Powell, who expressed concerns over the U.S. economic outlook amidst rising tariffs from the Trump administration. Powell's remarks triggered a swift reaction in both the cryptocurrency and stock markets. Bitcoin, which had been rallying toward $86,000, fell approximately 2.5% in the minutes following his comments, settling around $83,700. Analysts noted that this decline mirrored a larger sell-off in U.S. equities, particularly affecting the Nasdaq, which slid by 3.4%. The level of the tariff increases announced so far is significantly larger than anticipated, Powell stated, highlighting the potential for stagflation, characterized by stagnant economic growth paired with rising inflation. This scenario poses a dual challenge for the Federal Reserve as it attempts to balance its economic objectives. Quinn Thompson, Chief Investment Officer at Lecker Capital, remarked on Powell's hawkish tone, suggesting that investor expectations for rate cuts in the near term should be tempered. It appears a May cut is firmly off the table barring Fed intervention for bad reasons, he noted. In contrast to this bearish sentiment, other analyses suggest that expanding global liquidity could propel Bitcoin to new all-time highs. Matt Crosby, a lead analyst at Bitcoin Magazine Pro, has identified a strong correlation between Bitcoin's price movements and global M2 money supply, often exceeding 84%. Historical patterns indicate a lag of approximately 56 to 60 days between liquidity expansion and subsequent price increases for Bitcoin. This insight underlines the importance of macroeconomic trends in predicting Bitcoin's future trajectory. As liquidity conditions improve globally, Crosby projects a bullish outlook for Bitcoin potentially reaching $108,000 by June 2025. He emphasizes that while rising liquidity is significant, the rate of that expansion is equally critical in shaping Bitcoin's price dynamics. The year-on-year M2 growth rate offers a more nuanced view of macroeconomic momentum, he explained, drawing parallels to early 2017 when Bitcoin began its exponential growth phase. While the recent volatility in Bitcoin's price highlights the sensitivity of cryptocurrencies to macroeconomic signals, it also reflects a broader trend of digital assets becoming integrated into mainstream financial discussions. Powell's comments regarding the need for regulatory frameworks around stablecoins indicate a shift toward greater acceptance of cryptocurrencies within traditional finance. As the market continues to navigate these developments, investors are advised to remain vigilant and consider the interplay between regulatory changes and liquidity trends. The ongoing dialogue surrounding Bitcoin's place in the financial ecosystem suggests that while immediate challenges exist, the long-term outlook remains optimistic. Driven by a combination of expanding liquidity and evolving regulatory landscapes. As we look ahead, the ability of Bitcoin to adapt and respond to these changes will likely define its trajectory in the years to come. In an unexpected twist to the world of cryptocurrency, recent developments surrounding Donald Trump's ventures in the digital currency space have created waves of intrigue and controversy. As the former president continues to assert his influence, his family's crypto initiatives have garnered significant investment, raising questions about transparency and regulatory oversight in an already tumultuous market. On April 16, 2025, reports emerged that Trump's memecoin project had withdrawn $4.6 million from Coinbase just ahead of a staggering $309 million token unlock. This move has drawn attention amid the broader context of the Trump family's growing involvement in cryptocurrency. In a related development, the Trump family's crypto venture World Liberty Financial netted a $25 million investment from DWF Labs, a firm previously suspected of engaging in market manipulation. The timing of these transactions is particularly striking, coinciding with the disbandment of a Justice Department team that had been investigating cases of crypto fraud. Observers have noted that such actions could signal an environment conducive to questionable practices, with critics arguing that the administration is deliberately rolling back regulations that could protect investors. "Something smells rotten about the Trump administration squashing its crypto crime unit," commented Tony Kark, executive director of Accountable.us. If the president's business is going to continue openly taking foreign money this way, including from likely criminal elements, he must be transparent about what these foreign investors are asking for in return. The investment from DWF Labs, a firm that has faced scrutiny for alleged wash trading activities, raises further concerns. DWF's managing partner Andrei Grachev has been linked to a history of questionable dealings, including ties to a $4 billion crypto pyramid scheme. Following the recent investment, DWF announced plans to establish a New York office, positioning itself as a key player in the U.S. institutional crypto landscape. Such maneuvers have led to speculation that the firm may be attempting to shield itself from regulatory scrutiny under the current administration. In parallel, the price of Bitcoin has seen fluctuations, trading around $84,000, rebounding from recent lows. Analysts at Oppenheimer noted that while trading volumes have decreased, the resilience of the cryptocurrency market appears to be strengthening, suggesting a maturation of the asset class. It demonstrates that this asset class has matured and become more resilient, they stated in a recent report. Amid this backdrop, Trump has been vocal about his ambitions in the crypto space, highlighting the potential for deregulation and growth. His administration has garnered support from wealthy crypto investors who have funneled millions into his campaign, suggesting a mutually beneficial relationship that could influence policy decisions. As developments unfold, the intersection of politics and cryptocurrency continues to spark debate over the ethics of such relationships. With Trump's family poised to further capitalize on the burgeoning interest in digital currencies, the coming months will likely reveal more about the implications of these investments and the regulatory landscape that governs them. The evolving narrative raises critical questions about accountability, transparency, and the potential for corruption in an industry already fraught with challenges. As the crypto market adapts to these changes, stakeholders will be watching closely to see how regulatory frameworks evolve and whether they can keep pace with the rapid developments in this dynamic sector. The future of Trump's crypto ventures, including his rumored foray into video games based on cryptocurrency, remains uncertain but undeniably impactful. In a rapidly evolving cryptocurrency landscape, significant developments have emerged that highlight both the challenges and opportunities facing digital currencies. On April 16, 2025, Metaplanet, a cryptocurrency investment firm, successfully raised $10 million aimed at acquiring Bitcoin BTC in a climate where Ethereum ETH has seen its price dip below $1,600. This decline comes amid a broader panic in the market, with the Tron blockchain gaining traction as an alternative in uncertain times. The recent fundraising by Metaplanet reflects a growing trend among investors to capitalize on perceived undervaluations in the cryptocurrency market. With Bitcoin's current price fluctuations, we see a strategic opportunity to increase our holdings, stated a spokesperson from Metaplanet. The firm's decision to focus on Bitcoin demonstrates a renewed interest in the leading cryptocurrency, even as Ethereum struggles to maintain its value. As the market sentiment shifts, many investors are weighing the risks of holding assets that have been impacted by regulatory scrutiny and market volatility. In a separate but equally noteworthy development, Panama City has made a groundbreaking move by becoming the first government entity to accept cryptocurrency payments for taxes, fees, and permits. The City Council voted to allow payments in Bitcoin, Ethereum, and stablecoins like USDC and USDT. Mayor Mizrachi announced the initiative via social media, emphasizing the innovative approach taken to bypass previously stalled legislation. "We found a simple way to do it without new legislation," Mizrachi noted, highlighting a partnership with a local bank that will facilitate the conversion of cryptocurrency payments into US dollars in real time. This pragmatic strategy not only ensures compliance with legal requirements, but also promotes the integration of digital currencies into local governance. Unlike El Salvador's more radical adoption of Bitcoin as legal tender, Panama City's approach allows for optional crypto payments, mitigating risks associated with cryptocurrency's notorious volatility. This move could potentially set a precedent for other municipalities worldwide, showcasing how local governments can adapt to the growing trend of digital transactions without extensive legislative overhaul. Meanwhile, family offices are increasingly showing a preference for Ethereum ETFs over Bitcoin, reflecting a shift in investment strategies among high-net-worth individuals. As institutional interest continues to evolve, the dynamics of cryptocurrency investment are being reshaped, with Ethereum's robust ecosystem attracting attention for its potential in decentralized finance, DeFi, and other blockchain applications. As the cryptocurrency market grapples with these developments, the interplay between innovation and regulation remains critical. Investors are keenly observing the impact of governmental policies on cryptocurrency adoption, as evidenced by the contrasting strategies of Panama City and El Salvador. The future of cryptocurrency payments in public sectors may hinge on such adaptable approaches, paving the way for a broader acceptance of digital currencies. In summary, as the cryptocurrency landscape continues to fluctuate, the actions of firms like Metaplanet and municipalities like Panama City will likely serve as bellwethers for future trends. Investors and policymakers alike will need to navigate the complexities of this evolving market, balancing innovation with the demands of regulation. The coming months will be pivotal in determining how cryptocurrencies will be integrated into mainstream financial systems and what that means for their long-term viability. In the ever-evolving landscape of cryptocurrency, Solana SOL has recently garnered significant attention, particularly as it experiences a notable resurgence in value following a period of market turbulence. As of April 16, 2025, the price of Solana has surged by 36% from its lows during the recent crypto market crash, prompting analysts to speculate whether the asset could be poised to reach the $180 mark again. This optimism is underscored by a series of promising developments within the Solana ecosystem, including a rise in deposits and trading volumes that suggest a potential bullish trend. Despite encountering a setback after peaking at $134 on April 14, the underlying data indicates that Solana's momentum may not be fully extinguished. Currently valued at approximately $132.78, SOL remains 57% below its all-time high, reflecting the broader challenges faced by the cryptocurrency market, including a decline in decentralized application DApp activity. Nevertheless, analysts are pointing to a 30% increase in deposits on Sanctum, a liquid staking application, and significant growth on platforms like Jito and Jupiter as indicators of renewed interest and potential for sustained price growth. Solana's performance is particularly noteworthy when compared to Ethereum's Layer 2 solutions. In the week leading up to April 16, Solana's decentralized exchange DEX volumes reached an impressive $15.8 billion, surpassing the combined activity of various Ethereum scaling solutions by more than 50%. This remarkable achievement positions Solana as a front-runner in the DEX space, fueled by a 16% gain over the same period and substantial increases in trading activity on platforms like PumpFun and Radium. The growth of Solana's ecosystem extends beyond DEX activity. The blockchain has emerged as the second-largest platform by total value locked TVL, boasting $6.9 billion. Moreover, the rise of decentralized finance DeFi applications and new projects such as Ondo Finance and Exponent further illustrate Solana's expanding utility. Analysts are optimistic about the potential approval of a Solana spot exchange-traded fund ETF in the United States, which could enhance institutional interest in SOL. However, this optimism is tempered by the current lack of significant inflows from institutional investors. As the cryptocurrency market grapples with external economic pressures such as inflation and geopolitical uncertainties, investor sentiment remains a critical factor. While many have pulled back from crypto investments due to fears of volatility, social media platforms are abuzz with positive outlooks suggesting a potential rebound for market participants. In a significant development for the broader markets, Canada has launched its first spot Solana ETFs, allowing investors a direct avenue for exposure to SOL. This move puts Canada ahead of the US in offering such financial products, with 4 asset managers including Purpose Investments and CI Global Asset Management leading the charge. These ETFs are set to provide direct exposure to Solana tokens, a notable contrast to the futures-based ETFs that recently debuted in the US. The introduction of Solana ETFs in Canada marks a pivotal moment as it reflects a growing acceptance of cryptocurrencies within traditional investment frameworks. The ETFs aim to capitalize on Solana's high-speed, low-cost transaction capabilities, which have positioned it as a formidable alternative to blockchains like Ethereum. As noted by industry experts, these developments could set the stage for increased institutional adoption and pave the way for further innovations across the blockchain space. Looking ahead, the trajectory of Solana appears promising. With its robust technical capabilities and expanding ecosystem, coupled with the potential for broader acceptance through ETF products, SOL stands to gain traction as a leading digital asset. The increasing interest from both retail and institutional investors, alongside Solana's commitment to enhancing its infrastructure, positions it well for future growth. As the market continues to evolve, stakeholders will be closely monitoring the developments surrounding Solana to gauge its long-term viability and potential for price appreciation.